Almost every single person I talk to wants to reduce their taxes in retirement. But in reality, research shows that only 3 in 10 Americans actually have a plan to minimize the taxes they pay on their retirement savings. Hey there, welcome back to the Think Retirement channel. I'm Jonathan Rankin, and today I'm going to be talking about the top 10 strategies that can help you keep more of your money when you're in retirement. Now, whether you're nearing retirement or just starting to plan, these tips could save you thousands. So let's dive in and discover how you can maximize your savings. Now, the first strategy involves making strategic withdrawals from your different accounts. Whether that's your traditional IRA, your Roth IRA, or your brokerage account that you might have, being strategic in how you take money out of these accounts can help you stay in a lower tax bracket. This strategy, which is surprisingly only used by 32% of retirees, involves carefully planning your withdrawals to avoid pushing yourselves into a higher tax bracket. By balancing your withdrawals between your accounts like your traditional IRA, which is taxable, your Roth IRA, which is tax-free, and your brokerage account, which is subject to capital gains tax, you can manage your taxable income more effectively and reduce your overall tax liability. This approach is crucial because it helps you stretch out your savings further because it minimizes unnecessary tax payments. Now, the second strategy, which is similar to the first one, but it's only used by 30% of retirees, and that is mixing the use of traditional and Roth retirement accounts. This diversification allows you to have more control over your taxable income, especially in the years where you might need to pull out more money, but it's also important because it impacts the years that you're actually contributing to these accounts. Now, by strategically planning out your contributions, you can be more tax efficient in the years while you're working, and by having both account types, you can utilize the first strategy more effectively. Now, moving on to the third strategy, and that is making strategic charitable donations. Around 24% of retirees are using this method, but by donating to charity, you can reduce your taxable income while supporting the causes that you care about. It's a win-win because you get to support your favorite charities, but while you also get to benefit from the tax break. Now, the fourth strategy is using a health savings account or other tax-advantaged healthcare accounts. This is used by about 23% of retirees today, and contributions to an HSA are tax deductible, and withdrawals for medical expenses are tax-free. Now, additionally, HSAs offer tax-free growth on your investments within the account, making them a really powerful tool for managing healthcare costs in retirement. Now, given the rising cost of healthcare, having a tax-efficient way to cover these expenses is incredibly valuable. Now, this is the only triple tax advantage account, and the only catch is that you have to be on a high deductible health plan to take advantage of it. Now, the next strategy is to consider products like a permanent life insurance or annuities for their tax benefit. Right now, about 22% of retirees leverage these options. Now, permanent life insurance policies can build a cash value that grows tax deferred, and in some cases, you can access that cash value tax-free. Annuities, on the other hand, offer tax-deferred growth and can provide a steady stream of income in retirement. These products typically act as a safety net. They ensure that you have a reliable source of income while managing your tax burden. As I've mentioned many times on this channel before, when I've talked about insurance or annuity products, before you invest in any of them, the most important thing to do is assess whether or not it is actually the best interest of your specific retirement plan. Insurance products are often sold like they are meant for everyone, when in reality they're not, and should be based on your specific situation. Now, the next strategy to help you save taxes is making Roth conversions before you hit the age for required minimum distributions, or RMDs, or before taking Social Security. This strategy is used by about 19% of retirees to spread the tax impact over several years. Now, by converting some of your traditional IRA funds to a Roth IRA, you pay the taxes on the converted amount now at a potentially lower tax rate, and future withdrawals from the Roth IRA are tax-free. Most people are unaware just how large their RMDs can get. And what we typically do is we forecast what those RMDs are in the future and what that estimated tax will be. And this can be a significant savings to your tax liability during the course of your retirement. Now, the seventh strategy is to use qualified charitable distributions from an IRA, which is a strategy employed by about 17% of retirees. This method allows you to directly transfer funds to a charity, which is not only satisfying the RMD requirements, but also keeps the distribution out of your taxable income, effectively lowering your tax bill. Now, the eighth strategy is to make contributions to other tax-advantaged accounts like a 529 plan. Around 14% of retirees use this to save for educational expenses for their grandkids while enjoying the tax benefits. Contributions to a 529 plan grow tax-free, and withdrawals for qualified education expenses are also tax-free. This strategy can help you support your family's future while reducing your taxable estate. It doesn't impact your tax rate, but it will impact your long-term taxable estate. Now, the ninth strategy that is used by about 13% of retirees is to use the basis paid into the cash value of permanent life insurance to remain in a lower tax bracket. By withdrawing the basis or the amount that you've paid into the policy, you can access those funds without triggering a taxable event. And this method provides liquidity and financial flexibility when you need it most. Now, finally, taking advantage of a qualified longevity annuity contract, or QLAC, to set aside funds for later in retirement is a smart strategy that about 13% of retirees use. They do this to defer some RMDs, reducing taxable income during the early years of retirement. Now, QLAC allows you to purchase an annuity within your IRA that starts paying out later in life, thus delaying taxes on a portion of your IRA. This could be particularly beneficial for ensuring that you have some income in the later stages of retirement when other resources might be running low. So there you have it, 10 strategies to help you minimize taxes. Now, the earlier you start planning to minimize taxes, the more that you can do. It's really hard when someone is years into retirement and then they want to start actually implementing strategies, because by then it's often too late to take advantage of different strategies. It's like starting to train for a marathon that's taking place next week. You could probably try, but it's most likely going to be too late. Now, if you need help minimizing taxes, use the link in the description below and schedule a time with a member of our team. We'd be happy to see how you can keep more of your money and give less to Uncle Sam. Now, with that, if you're planning on retiring soon, make sure you check out this video coming up next, where we reveal 3 retirement spending trends that you need to be aware of. I'll see you there.